Okay, everybody, let's talk about corporate bonds. From time to time, I purchase corporate bonds, and I have members in my service that I provide. And occasionally, some of my members might ask about corporate bonds. We have I should say, have a Discord server where the membership takes place, and where a lot of the people, or actually, where all the services take place is on the Discord server. And there's a channel on there and I'll show that at the end of this video, guys. It's a fixed income channel on that server. And from time to time, I'll drop in there some corporate bonds that catch my eye. Now, I've been trading a long time, several decades. I started out trading, believe it or not, savings bonds, if you want to call it trading, but I bought savings bonds as a very young man, teenager. And then I graduated to stock. And then I got into buying some corporate bonds, started understanding those, which we'll cover some of that. That's what we're going to cover in this video here in a minute. And then eventually I got into trading derivatives like options and futures. Nowadays I trade mostly futures, but occasionally I still trade corporate bonds, or I purchase them. Okay, and we're going to talk about that today because a lot of people, especially the young generation, they don't have any idea what the heck are corporate bonds, and why would you waste your time with that? Sounds so like archaic, or we don't do bonds, we're young people, we only trade stocks and derivatives. Well, let me just tell you, if you're young, and this whole video is my opinion, not advice, obviously, but if you're young, I think it's a great idea to buy corporate bonds and hold on to them for your entire life, especially with those that have maturity dates that are way out in the future. Okay, some of them might go out way past this. They might go out into the 2040s. Okay, and why do I say that? Because corporate bonds, like you see the value over here of this particular corporate bond, we're just going with $1,000. Okay, that would be what's called par value. That's the value that the bond was issued at when the company or corporation, that's why it's called a corporate bond. Let's say it's Microsoft. It might be Procter & Gamble, Nabisco, whatever. Some of these companies put out corporate bonds. It's basically an IOU. They put out a bond, you buy it, they pay you interest. And then they pay you back your principal at the maturity date, way over here. All right. So that's the basic principle behind bonds, but there's some complexity associated with buying bonds. So we're going to cover that. Now, getting back to the point I was trying to make about should young people buy corporate bonds, or is it fixed income just for old people? No, this is where a lot of young people make a big mistake. You should buy corporate bonds when you're young. Muster up to $1,000 from your paychecks and buy a corporate bond. Okay, and after you get done watching this video, hopefully you have at least some idea how to pick the best ones. The reason I say that is because if you're in your 20s or 30s and you're buying corporate bonds, and every one or two paychecks or whatever you can, much you can muster up, you should be always trying to purchase a corporate bond when you're young. Just keep on purchasing bonds in your brokerage account and don't sell them. Just keep socking them away. Because you know what's going to happen by the time you're 50 or 60? There's a good chance you're going to retire, and you're not going to have to worry about what to do during retirement. Yes, I know when you're young, you want to catch the pot of gold at the end of the rainbow. Bing, pot of gold, right? Everybody wants a pot of gold over here at the end of the rainbow. And when you're young, you can take those kind of risks, and that's great. But I'm here to say to you, to give my opinion that yes, I think it's okay to continue to invest in derivatives, of course, trade in derivatives, but you should be putting at least some of your money, in my opinion, away into corporate bonds. So that when you get to be an older person, you're not freaking out about how you're going to retire. Because I got a news flash for you. Social Security ain't going to cut it. Heck, it might not even be around when some of you young people retire. And if you got an IRA, that's pretty good. But if you have a company that you work for that has a 401k, all right, and they contribute, that's an important part, you should definitely participate in a 401k. Let's say you put in $100 each paycheck, and they put in, I don't know, $100 too. Maybe they only put in $50, doesn't matter. This money they're putting in is free money for you, free. It's a beautiful thing. I've had some 401ks in the past in some jobs I've had, and those are the jobs, by the way, you should be looking for, to have 401ks where the business that you're working for contributes and participates in 401k. So that's free money for you. And the other benefit, obviously, to 401ks is during the time that you have this 401k, it's tax-free. And a lot of young people, they think, oh, big deal, tax-free, schmiggy schmig, my taxes are so low. That's true when you're young, taxes tend to be low. But as you get older, this becomes a huge burden. Okay? So tax-free is a beautiful thing. I know a lot of young people that were smart, and by the time they got into their 50s, they retired because they were smart with their 401k. They made huge money. Now, I'm not saying it's going to be true for everybody, but you should be considering this, okay? So, and I do believe you can actually buy corporate bonds within a 401k or at least within an IRA, so you should be looking at that as well. That's even better. All right, so back to corporate bonds. Let's talk about this. How do we pick good corporate bonds? What are some differences? Let's look at two corporate, in the old days, a lot of corporate bonds, you could only buy a corporate bond for $10,000. When I was a young man, this was very common. You had to come up with $10K, the minimum, to buy corporate bonds. That's how it used to be. This was very prevalent 20, 30, 40 years ago. Okay? Nowadays, you can buy them for $1,000. But back then, it was $10,000. So you guys got a lot easier. Okay? Now, the bonds I'm talking about, there's two different markets. There's the primary market and the secondary market. You're going to be most likely participating in the secondary market. These are bonds you're going to be purchasing after they've already been issued. Okay. So let's talk about this. $1,000 bonds called par value. Almost all bonds nowadays are issued at $1,000. That's their initial issuance price, $1,000. Okay. Now, let's say some time passes by. Let's say that this bond, I don't have an issuance date here, but let's just say it was issued in the year 2020. Doesn't matter. And now we're in 2024. So 4 years later, let's say this bond is now trading on the secondary market at $1,200. So it's $200 more than what it was issued at. Okay, jumping way over to the right, we'd call that, I shouldn't say bought, but in any case, this bond, since it's $200 more than its initial issuance price, it's trading at a premium. We call that a premium. It simply means it's trading at a price higher than was issued, than it was initially issued, okay? So pretty simple, right? It's called a premium. If you look at the one below it, in this example, I have a discount. And why is that? Same scenario here. The bond was issued at $1,000, but let's just say it's the same thing that was issued in 2020, but it's 2024 now when I'm doing this video, and it's at $600. So this price of this bond's gone down. Well, that bond we'd say it's trading at a discount. That makes sense, right? Discount. It's below its initial issuance price of $1,000. So that it's really important to understand the difference between premium and discount. If it's trading above the par value or $1,000, it's going to be a premium. If it's trading below the $1,000 issuance or par value, then it's considered to be trading at a discount, okay? All right, so I'm going to pause right here for a second and just say to you that for me personally, I'm almost always looking for bonds that are discounted. And later it'll become obvious why. Now, we'll talk about the good and the bad of looking for discounted bonds, because there is a good and there's a bad. Okay, so let's move on. Now we're moving on to the third column here. Coupon. Well, what is this? This is the rate at which the corporation that's issuing this bond will pay you for your $1,000. So in this case, 10%. So if you bought the bond at $1,000 and they pay 10%, you make $100 per year. You make $100 a year on this bond. Okay, you're getting 10%, which today, nowadays, that'd be still a pretty good rate. Okay, it's not great considering inflation, but it's still decent. So you make $100 because obviously 10% of 1,000 is 100, right? You just multiply 1,000 times 10% or 0.10, you're going to get this $100. Okay, let's look at the bond below it. Same deal, $1,000, but this coupon rate's much lower. It's 5.25%, not 10%, so almost half. And but you notice over here it says $105. How the heck does this bond, it's nearly half the coupon rate or the rate that the company's going to pay you for this bond, how the heck are you making $105? That can't be right. Right? Something's off, correct? Okay. Well, there's a couple things we're going to talk about. We're going to talk about yield to maturity and how the yield to maturity is going to impact the quantity of bonds that you can buy. They go hand in hand. All right, so this first bond, you look at, let's just say you're scouring through bonds and your broker, whoever that broker is. It could be well, nowadays that's Schwab. It could be Fidelity. There's some other brokers that have bonds. Okay. And you see this bond, okay, of course, almost all bonds nowadays have a par value of 1,000, and then you see that the price is 1,200. So you're like, wow, this bond's trading at a premium. I'm not sure I like it, but man, that coupon rate's great at 10%. But what is this yield to maturity stuff? Now, by the way, this maturity date and this yield to maturity are not calculated properly. This is just an example, so don't beat me up. Don't hit me over the head in this video in the comment section about you don't have your yield to maturity percentage right. This is just an example, okay? The yield to maturity is low because the price is at a premium. So it's below the coupon rate. That'll be, you'll see that almost every time. If the price is higher than the par value, and then you have to calculate the maturity date, which I didn't do that in this example, but the calculation includes the maturity date, how far out the maturity date is. What is maturity date? Maturity date is the date that the company will pay you back your $1,000. That's right. Even though you paid $1,200, they're only going to give you back $1,000. Over here, you paid $600, they're going to give you back $1,000. Woohoo! That's one of the benefits to a discounted bond we talked about earlier. We'll talk about that later. It's called a capital gain. That's this column here. We'll talk about that later, okay? But for now, getting back to yield to maturity, this is important. All right. So this bond, clear the screen here a little bit. This bond is costing you $1,200 to buy. This one's costing you $600 to buy. Now, I made this example kind of easy because it should be obvious that for this one bond, I can buy 2 of these, correct? Because 6 times 2 is 12. So even though this bond's giving you 10% coupon and this is only giving you 5.25, if I buy 2 of them, I'm getting 10.5, right? I'm getting a little bit more. So yield to maturity is telling you an easy way of determining that in reality, this bond down here at the lower price but with the lower coupon rate is a better deal for you, especially if you can buy multiple quantities. Okay, and that's important to understand that. Sometimes it might be okay to pay this premium and buy this one bond at an expensive rate. Let's just say if this bond over here, if I can get this to play nice. Let me clear the screen here. Let's say this bond was more like $900. Okay, it would change the yield to maturity. It would probably impact this yield to maturity. This number would change. And you can now tell that it's still cheaper than 1,000. It's better than this bond, but the yield to maturity wouldn't be as good. And you would find out that even though the yield to maturity this yield to maturity still be higher than this one, it'd only be slightly higher. It may not be like 1.5, it might just be like 0.5 point. And the reason I'm mentioning that is because you might not have enough money at the time you're looking to buy a bond to buy 2 of these at $900, which costs you $1,800, but you might have enough to buy the one for $1,200. and you like this rate at 9%, your yield to maturity, the amount of percentage you're going to get if you hold the bond all the way to the maturity date, you're going to get 9% on the average, basically per year. Because you paid a little bit of a premium, so you got to take that out of the interest you're getting paid. All right. Now, I've done that in the past. There were some bonds that I knew had better yield to maturity, but I didn't have enough money to buy two. Let's say in this case, you see I bought two here, right? I didn't literally do this, but I'm just for example's sake. If I can't afford to buy the two, I might go ahead and buy the one because the rate is still really good at 9%. I can't always get the best of the best if I can't afford to buy two of them. You follow me? And sometimes waiting's bad because this bond, which looks like a pretty good deal, whoop, might disappear off the market. Whoop, you had your chance. Okay, so sometimes it is okay to buy a bond at a premium, though I try to resist doing that. Okay, so back to the $600, $1,200 example. In this case, if I'm willing to buy this for $1,200, I'm certainly going to buy two of these at $600 because it's the same money, and I'm getting a better yield to maturity. I'm making a little bit more money each year, making $5 extra a year. But guess what? Here comes the real benefit. In the year 2035, I'm going to get a $400 capital gain. Okay. Now, the last thing I want to talk about over here real quick is, generally speaking, when you have a really good yield to maturity compared to other bonds, that bond might not be, the quality of the bond might be considered average or even a little bit speculative, whereas this one up here might be considered good. So just keep that in mind. You can look at that through like Moody's and S&P rating system will tell you the quality of the bond. So you need to do due diligence. In other words, how strong is the corporation that you're buying the bond from? All right. All right. So I hope you understand. My opinion is you're trying to go for a discounted bond with the best rate you can find. Okay. And hopefully you can buy quantities of them, not just one. And that's how you take advantage of the yield and maturity and make big bucks throughout your lifespan, guys. This is not a get rich quick scheme. This is hold on to it for a lot of decades and keep piling it on. All right. And trust me, it has helped me in my trading as I got older to have those bonds in my portfolio. All right. That's it for now, guys and gals. Hope you really enjoyed the video. If you want to become a member, just click the link in the description below this video, and it'll basically it's pretty simple to buy a membership for $7.99 a month. It's a really good value. All right, talk to you all later.